Welcome to Finance with Factor,
Oops, apparently we're already recording, so here we go.
a place you can come to laugh and learn from local experts who love to discuss everything related to the world of real estate.
Weird passion. It's one that I actually share a little bit, so it makes me a weirdo with you.
Each week we'll cover a unique topic
Let's talk about condos.
to help you understand the mortgage industry, navigate the home buying process, and grow your business while maintaining a slice of sanity.
Okay, fine. I've been confused by a lot of things over the past few years.
Now that he's climbed safely atop his soapbox, here's your host, a senior loan officer with Movement Mortgage, Jason Factor.
Today is going to be a little bit different than past episodes. If you've been listening to this in the past, thank you. I highly recommend that you check out our last episode, which was a Scary Things episode, Halloween special. We took last week off from Finance with Factor recordings because of the election. And honestly, I just didn't think that anyone wanted me in their social feeds last week. Figured everyone could probably use a break from the news for a bit. But today we're back with a vengeance. And that vengeance is going to be a little out of character in that this show is usually not, well, it's about real estate. It's not about, certainly not about politics. It's certainly not about predicting the future, really even about rates in general or specific or hyper-specific real estate things. What I try to keep this podcast about is more the generalities and tips and things that people can do, more transferable skills, if you will, to home buying. Today, however, I want to get into the deep weeds. So if you thought last week's episode was scary with all the haunted stories and ghost tales and scary things that can happen in real estate, just wait till you try to dive into interest rates and the mortgage math. Today's guest is Ryan Hayes. He is the president of the Massachusetts Mortgage Bankers Association. He also happens to be a regional vice president and area director, I think is the proper term, at Movement Mortgage, which happens to be the place that I work. So before I bring Ryan on with a couple of questions and everything, I do want to give some disclosures. Legal will love this. Anything we are talking about today is just that. It is talk. Rates are subject to change. In fact, they change daily, if not hourly sometimes in some markets. What we are discussing today is obviously a snippet of a moment in time. But what I'm going to try to do today, or the goal of today's podcast, is just try to provide some context for what's been going on in the market, what you've been hearing versus what the realities are, and just answer the big question, why? So today's guest, Ryan Hayes, welcome to the podcast. But as I welcome you, I want to do so with our first question, which is, what the heck is going on out there, man? Can you provide a little bit of a history lesson for what happened over the past year, couple of weeks, months that led us up to where we are right now in the rate and real estate world?
So first thing I want to do is I want to just take everybody back to where we were in January of 2023, right? And I think sometimes it's hard to really understand how big of a decline we actually had leading to the fall of last year, right? If you take a look at sort of where we touched down, we are right now currently almost 700 basis points better than where we were 1 year ago. So rates have done a lot of work over the last year, even though this volatility that we've had, these ups and downs have been quite a roller coaster ride. What we've seen is, from here to here, almost a 700 basis points increase. And for us, right, like that's something we've got to make sure that we understand. So we saw one of the most historic and quickest downfalls, and then really a year of getting that back, leading into summer and then into, our end of summer into, late September refi wave. So, when we think about where rates are, where they've come from, when we think about what the Fed's going to do, it's really important for us to understand that rates have really done a lot of work. So why don't we start just a little bit more recent history with what's happened? Because I think one of the biggest issues that we currently have is that we talked with a lot of borrowers in August and September. Rates were on the front of almost every newspaper, on the front of all of the cable news shows and websites, and what that really did was it brought rates into the forefront, into the public, right? We always used to joke around, rates could do whatever they want, but as soon as it was on, as soon as the USA Today put a headline about rates decreasing, you'd get a lot of phone calls, and it didn't really matter what was happening. So you saw sort of going into that period, rates rallying into the summer. And then what we had happen was on the 17th and 18th, the Fed met in September and they cut rates 50 basis points. Everybody knows, everybody fielded a million phone calls about why rates should be lower because the Fed cut rates. What we know is that the mortgage market skates to where the puck is going, not where it's been. And what we know is that the market had priced in, quite a bit of Fed loosening through the end of the year already. Sort of coming off of the heels of that rate cut, we saw a really hot jobs report. So a couple of jobs reports coming in that supported a slowing economy, and then sort of boom, out of nowhere, a high jobs report. That jobs report coincided with, when the sort of election predictions started to come into play, and we started to see, a bit of a decrease here going into October. Okay. And I'll just bring this back up here. So 17th, 18th, we get our Fed cut, we get the jobs report that comes in hot, and we start to see a pretty steady decline. Okay. And then really these declines in here were sort of a selling spree that was a little bit unexplained. There wasn't a ton technically going on after this. So a lot of speculation on, is it the election? Is it this, huge monster week coming into the end of the year coming up? But really what we saw was a lot of positioning here of investors that were going to be worried about what started this week, right? Which was basically that, starting on Halloween. So on Halloween, we had CPI, right? So there was really sort of four things. Somebody asked me right before that week, what do you think rates are going to do? Do you think I should wait till after the election? I said, we've got to go through four things to sort of get some rate relief before that happens. One was CPI, two was jobs, three was the election, and four was the Fed rate cut decision. And now we're on sort of the other side of this and sort of rallying or getting back to hopefully this place where we were before that happened. So CPI comes in, it hits its forecasted number, but it was a little bit of a mixed report. Some of the core numbers that were in there showed a little bit stickier inflation, even though wages had come down. But then what ended up happening was on 11/1, right, we had our non-farm payroll. And normally a non-farm payroll miss like we had would have spurred a big rally in the bond market, right? It was, 12,000 forecasted on 100 something thousand. But there was an interesting underlying piece in there that I think really got investors nervous. investors of mortgage-backed securities nervous, and that was that the unemployment rate stayed the same, leading to a whole bunch of talk around, is this hurricane related? Is this strike related? Is there some noise inside that report that would make it show that it wasn't as big of a miss as it really was? I think right around that same time, we started to see the sort of Trump and Harris election piece coming back together.
Hold up. Because before we go any deeper, I need to say you've just touched a third rail here on Finance with Factor, and that we try not to talk politics. I did warn people up front that we would be doing that today a little bit. It's sort of inevitable if you're going to go through the history of the last couple of weeks and months and even 2024 in general. So before you dive in, how traditionally have elections impacted mortgage rates, economies? And my information has always been that, I do want to give the clarification that presidential elections, statistically speaking, have not impacted home values. It's just not. I mean, if you look at all the data, it says who is president does not impact the value of your home. However, presidential policies can certainly impact economies, and economies can impact rates. So without going into too many details here, I guess my question would be, what did this election mean for rates, specifically to what we're seeing in the market right now?
This is a non-political description of this election. I think traditionally, we would not have seen the same thing before in an election that we see won by Republicans, right? And generally, and what I think a lot of the public will think is, if a Republican Congress and president is elected, they are typically more fiscally responsible, have less spending. And so in that case, the position of the US government should be better in terms of not issuing more debt, and rates would rally. There's a sort of a big difference here, and really it's no different. The United States government is no different than any other business, right? We both have expense and revenue, right? And typically the Democrats are associated with expense, right? With spending in national programs. And typically the Republicans are on the revenue side, right? And the decreased revenue of tax cuts and really just economic stimulus in general. And so when we started to come in, it was less about whether Trump or Harris would win, and much more about whether we would see one party sweep the election. And what we did see, or what we're seeing, is likely a one-party sweep of the election, which is why on election day we saw that big sell-off. So whether it would have been Democratic or Republican, the biggest piece here came from 2 years of easier policy implementation, and be that on the Republican side, tax cuts, tariffs, things like that are all sort of viewed pretty widely as inflationary. And if inflation comes back, Fed has a lower tolerance for tightening. Country has to issue more debt, right? There are lots of issues for the United States rate market in that way.
Okay, so I'll pause again and reset. For people that have been listening, and maybe we've lost you at this point, and if we have, I apologize, but we've gone through a quick history lesson of what's gone on so far in 2024, and we've caught up to November 6th. We've had an election, we have results. Now, the following week, we had a Fed meeting, and the Fed was well predicted to cut rates by a quarter, and they did cut rates by a quarter. But all year, for the last 3 years, really, we've been telling people the Fed does not control mortgage rates. The fact that the Fed cuts rates does not mean that your mortgage rates dropped by a quarter of a point. So my question to you is, what I understand is that what markets really care about isn't necessarily the Fed's actions, but rather what did the Fed say? And so, Ryan, as the president of the Massachusetts Mortgage Bankers Association, someone who sits daily on capital calls and watches rates across a variety of banks and lenders, particularly here at Movement and a lot of our products, my question would be, what did the Fed say that seemed meaningful to you? What did you hear?
Our last piece of economic information came from the Fed, and there was 100% chance built in to the market that the Fed was going to cut a quarter. The Fed did cut a quarter, so there was no surprises there. But most people were waiting to hear what Jerome Powell would talk about, and he had a sort of a great press conference where he had some pretty funny viral moments. Starting with whether he would step down if he was asked to by the administration, which his answer was just no. To really tempering the thought that this election currently would be inside the Fed's idea. He also talked about inflation being where it wanted to be. He played both sides, talking about how it was just as important to not keep a restrictive policy like they have now as it is to cut too quickly. So he did a really good job of talking through the Fed's position and going forward. And so what we saw was a little bit of a rally come back here, or maybe a little bit of a bounce off of the bottom come back here, sort of after we got through this week.
You say we got through this week like it's some sort of act of survival, climbing Everest, which honestly maybe is true. But so as we kind of take a look back, you just mentioned, without predicting the future, because again, not something we do here, so please don't even try. Nothing we say here is Nostradamus. But what is your sense for what the Fed actually said and what you took away from those comments? As you said, we skate to where the puck is. So if we're skating to where the puck is, what is your sense of where we're going?
So what I think we're seeing now over the last couple of days is everybody's been able to take into account, okay, what is the overall picture now? I think, if you were to say, take the one party sweep out of it, what you would say is most of that data that came in really does support the Fed's policy and Fed's positioning to continue to cut rates. Now, I think we still do have that wild card on the government side and spending side and revenue side, really, in terms of taxes. But what we saw is we got through this period of economic sort of uncertainty, right? That we are still on this downward trend with the economy, right? And it's not huge. The labor market is still tight, but it is softening. The inflation numbers are not where we want them to be, but they are softening. And the Fed is really, and Jerome Powell specifically, is really talking about making sure that he does not take too long to bring this restrictive policy back, because I think he knows the backside of that and what the issues are, right? So that sort of gives you a where we are right now. I think going forward, a couple of things. I am not clear about where rates are going to go, but what I'm clear about is we are going to continue to see volatility. And I think you've got both issues with volatility when data comes in, but you have other issues with volatility with what's going to happen as the markets start to figure out what the administration is going to look like and going to do in 2025. So I think some of the issues that we may have in this volatility may come from things like cabinet appointments, may come from things like, you know, offhanded comments or comments from either either Trump or his team about what he's going to do, and that will spark investors to try to figure out and go one way or another. A lot of companies, a lot of investors utilize these mortgage-backed securities for hedging. And what they want to do is they want to pull in the most liquid or the most traded securities to do that. Then you look at actual mortgage companies like us who are delivering into mortgage-backed securities.
Perhaps I've done a disservice because I've said the Fed does not set mortgage rates, markets set rates, but we haven't actually talked about the markets themselves that are setting the rates, and that is the Treasury and the mortgage-backed security market, which are some of the ones that we follow most closely. And I guess my question to you would be, as someone who watches those closely, what are you seeing in the mortgage-backed security market? And more importantly, what do the experts, the people trading these markets that really move markets, what are they seeing? What are the trends that are impacting rates right now?
So a couple of things have happened, right? And I think one of the biggest was Stanley Druckenmiller, who is a sort of very well noted bond investor. As soon as the election results came in, and that sort of coincided with the 50 basis point rate cut, he shorted the bond market pretty significantly, and obviously was proved right there. But a lot of these bond investors are short the market right now because of the thought of the potential inflation that could come from economic policy in the first half of 2025. So there is a pretty good sort of majority of these bond investors out here who are not feeling like rates in the short term are going to come down. It's not something that we know for sure, but it's something that we certainly have to prepare for, right? We have to take sort of everything into account. I think auctions are another thing that go out there. If you're assigned to an MBS Live or a MBS Highway, you see the auction results. But really, this is just what the demand looks like outside of for U.S. Treasuries, for mortgage-backed securities, what that demand looks like on the open market. And if you have low demand for that, right, you've got to increase your yield in your auction to get them sold. And what we saw was actually over the last, few days during those auctions, we actually saw some stronger auctions in there, meaning people felt like the 10-year was appropriately priced. So you'll read lots of stuff about technicals. You'll read lots of stuff about moving averages. There's a ton out there and a ton of information to process. But I think where I still sit is we are going to see a lot of volatility. We are likely not going to see rates come down quickly. We are likely to see, when rates come down, it done in pops or little sort of spurts like we saw in September. And we've got to be able to take advantage of that, right?
You talk about windows, and you mentioned that September window. The windows in a volatile market can be really small. And what I mean by that is the daily volatility that we see when we look at rates and where things move and how they trend. And while you don't typically see rates jump overnight, in a volatile market, you can see kind of big swings. So I guess my question in here is, what advice would you give to people who are homeowners who are looking to refinance, home buyers who are shopping around and thinking like, is now a good time? Or even people who are as far as they have an accepted offer and they're shopping around for rates, they get something they like. What would be your advice to customers out there in a volatile market?
So, it's one of those things where I really do feel like when you have a little bit of green, when you get a day like yesterday, I probably had 6 questions with a day like yesterday asking me, should I wait till tomorrow to lock? Because I think, right, we even though we repriced, I think it's going to be better tomorrow. And look, we're up about 6 ticks today, up about a quarter percent today, sort of where we were off of yesterday. But I also do think that you are sort of one headline, one quote away from that volatility sort of coming off in erasing, right? So you just have to be really careful with what you're doing right now. We've talked through this, but we are making some headway back. I do again just want to caution people on not taking advantage of that.
So it sounds like the only thing you've been willing to really guarantee us so far today, and with good cause, and it's not a crack, is volatility. And if we're going to see a volatile market and that moves at the whims of a headline or an investor getting a hunch and making a big move, what is your advice to realtors, loan officers, and home advisors, I guess? That's a terrible way of saying that. To financial advisors, real estate professionals, loan officers, home buyers out there, what is your advice on trying to, and this is the curse word in our market, but time the market? What is your advice to people that are out there that have been waiting on the sides and are trying to think through, is now the right time?
For us being able to talk through with customers why they should not wait for lower rates. I think you've got a lot of ammunition to show borrowers who did not lock or thought they were doing things in the right over the last month. I know people clip these articles, clip these charts to send to borrowers. It is important to make sure that you are presenting the case about why you should be locking, why you should take risk off of the table, especially if it comes where potential issues for qualification and things like that.
So again, not financial advisors. Never pretend to be. I can't say that enough, or at least so compliance tells me. But when I have a retirement account, that is my big investment in life, right? Is my retirement. But one of the other big investments in my life is my home, my real estate. It's one of the biggest investments that I've ever made and will ever make. And real estate is an important part of my overall wealth and portfolio. I say this because you've mentioned we're going to see volatility. You've mentioned that we're going to see rates come down eventually in bits and spurts throughout the year. And timing the market is one of the most difficult things. I can share a quick personal story. So I had a client not that long ago called me for a refinance, wanted to consolidate a home equity line and his primary mortgage. The home equity line, while coming down a little bit, was more than he wanted to pay. Again, what he can afford versus what he wanted to pay. And his financial advisor said, it's time to refinance. You should see if you can consolidate these. I sent him a quote. It was saving him $1,500 a month on what he called his blended rate. It absolutely made mathematical sense. He went back to that financial advisor, and the financial advisor said, well, I think we should wait because the Fed's going to cut rates and things are going to come down again. And I pause here because obviously that didn't happen, right? The Fed did cut rates, but rates have not come down. That was bad advice. So the reason I say this is not to bash a specific financial advisor, but more specifically to bring up examples of the fallacy that is timing the market. And what we are going to try to do, at least here at Movement over the next year, and you've been hammering this home, and we've always done this, is what we call here at Movement our AMR, or our annual mortgage review, and where a loan officer stays in touch, hopefully a client for life. We stay in touch, we send out a quick survey, we go through, we call them, we follow up, and we go through what's going on in your life. Where are you in this? Is this mortgage still the right mortgage for you and your financial situation? I always joke with people that you don't buy Disney stock because you like Disney movies. That's a bad investment strategy. You don't buy Apple stock because you like an iPhone. It's a bad investment strategy. In order to make a good investment strategy, you need to work with either your financial planner or someone who follows markets closer than, say, I do during my day job, and work with them to make sure that I'm planning appropriately for the investments that I want to make in my larger financial goals and my life plan. And that's hopefully what a loan officer should be doing for people. And I guess my question, because none of this is a question, my question is, how does that process, why do you value that process so much? Why is that something you guys have been hammering home? And is that something that you think financial advisors, realtors, and certainly loan officers should be building into their daily practice? And if so, how, why is it important to you?
These annual mortgage review emails that are going out that you can follow up with your customers, warm phone calls to talk to them. All of this stuff is in the news right now. Rates are in the news right now. The Fed cutting rates is in the news right now. These are going to be good, productive conversations with people. So make sure you take advantage of that. You've got a lot of good information about what's happened over the last 60 days that shows you as an expert versus what they read in headlines, what they felt was going to happen in the market, things like that. So hopefully that gives everybody a little bit more ammunition.
Ryan, thank you for doing this. I know it is a crazy amount of time that you spend looking into all this stuff. You have way more important responsibilities than talking to Jason on his measly little podcast or informing the hopefully hundreds of billions of people listening to it today. But I really, I really do appreciate you making the time to chat, walk people through it. I thought that the meeting you did internally that you led, the capital market call, was awesome. And so I just wanted to bring that call basically out to the masses. So thank you. And I appreciate it.
I'm always happy to chat, always happy to shoot an email over, always happy to pass along anything I can. But hopefully this was helpful. Hopefully you got a little bit more information here for to have some of those conversations. And to me, right, it's all about trying to keep customers informed, right? And I know it's been frustrating for a lot of us because we've talked to a lot of customers and they said rates were going to come down, or we're going to wait till after the election and rates are going to come down and all that, and it really hasn't come to fruition. So utilize that as a talking point. Utilize the potential of the issues with the 2025 administration coming in. Utilize all of that to try to people. I appreciate everybody on here. I appreciate everybody's support. And if you need anything, let me know.
Of course. And thank you. And honestly, Brian does mean it when he says call, text, email him. In his capacity as the president of the Mortgage Bankers Association here in Massachusetts, he absolutely does respond to people. But I've also strongly cautioned him to be careful when offering those types of services to me because I take him up on it and I invite him back. So Ryan, thank you again for doing this, and to everyone else, hopefully this was helpful, and we'll see you again next time.
Thank you for listening to this episode of Finance with Factor. Please remember to like, share, and subscribe. Then if you really like us, open another podcast app, Apple Podcasts, Google Podcasts, Spotify, or really wherever else you enjoy podcasts. Search Finance with Factor and do it again. The more places you like, share, and follow helps our ratings. But that can be our little secret. Have a question about today's episode or an idea for an upcoming episode? Post a comment. For more content, follow Jason Factor on YouTube, Facebook, and Instagram at Finance with Factor. All content discussed on Finance with Factor is self-published by Jason Factor, Senior Loan Officer, NMLS number 1401985. All rates, guidelines, and advice shared on this episode is subject to change. To contact Jason directly or for a full set of disclosures, visit his website at jasonfactor.com.
Jason Factor, NMLS number 1401985. Movement Mortgage supports equal housing opportunity. NMLS number 39179. NMLS, consumeraccess.org.